Well, thanks everyone for joining today. What we want to do is take 25 minutes, as we've done many times in the past, and take a look at um, what I call beyond the horizon, or maybe this time, is it going to be a soft landing or a bumpy road? Let's look at some facts in the next 25 minutes and see what conclusions we can draw. Those of you that know Alpha V attend our webinars that we publish regularly. We're a research provider. We've been around since 2010, so 14 years, and have an advisory business. So we do a lot of institutional work. There's also a large software group, software offering for a variety of different kind of functionality. We build direct indexes for advisors, portfolios. We've licensed our work to companies like Wisdom Tree and American Century Investments. We're on a lot of different TAM platforms. We have some public Euro notes as well. So you can find us on a lot of different platforms. And again, to follow along to see the results and how we think about risk, the markets, you can follow just by going to cnbc.com and pull up a lot of our different investment strategies are available there. So follow over time. Let's get into it. We want to look at the S&P 500 trends, some thoughts on price multiples. I want to talk a little bit about inflation, what we're seeing on the unemployment numbers, consumer confidence, and something I like to look at as M2 money supply and velocity. See what kind of conclusions we can draw from that. And generally, I don't like to look more than 90 days or so ahead. People that try and predict where the S&P is going to be in 12 months, I don't put a lot. It's nice and fun, but I don't put a lot of faith into that. So first thing is risk is variable. I'm often asked, is risk on or off? I hate that question because risk is never off. It's always on. It's maybe a dimmer switch, not a light switch. How much risk is there? And I know this is a customer-facing kind of slide, but you can see, will we get to 6,000? We're at what, 5,800? Or I haven't looked just recently today. Are we going to get there? Well, we're certainly heading that way real quick. But the message is from this slide, avoid that temptation. Keep that 48-month, 60-month time horizon always. Yes, you should be rebalancing and reconstituting, but don't try and time the market. Don't try and chase performance. We can see, 5,800 with a return of 192% over the last 10 years. All your clients are going to be quite happy, and it's just as much of education and psychology as anything else. Now, when we look at the price multiples, though, of the market, because the market does starting to feel high to a lot of people, including myself, and I want to try and systematically think through that. And as we look at the company's share price to their, and their earnings, come up with that EPS number and look at the overall market, we can see that, currently we're at over 29.4. And certainly after today's close, we'll be there. And that's significantly higher than where we were, over the historical average of around 18. But when you look at that, it says investors are willing to pay for that high multiple because they are expecting future growth. There's confidence, and they're paying that premium for those earnings. But, again, in the modern era, we're quite high. And now that can be caused from a couple of reasons. Is it a bubble? Are there other effects? Let's keep looking at the different factors. We have a lowering interest rate environment. We're recovering from that pandemic and the supply chain interruptions. And there's generally a lot of investor optimism. But that conclusion alone, in and of itself, looking at just a single number of 29.4, many would say it's quite overvalued compared to historical averages. But again, being cautious is always prudent. There can be other factors, and we want to explore some of those other factors that we like to monitor that I outlined in the first slide. So one of the things that's a big factor potentially is productivity. And we've seen these kind of productivity boosts over our history. And absolutely, productivity plays a big role and can change price to earning ratios. And the advancement of one that we're going through now is AI. And that AI can potentially have a huge boost to productivity. And if there's a boost to productivity, you get increased efficiencies. And with those routine tasks, reduce errors, streamline operations, reduced labor means more profit, higher PE ratio does make sense. As companies reduce their costs, labor costs, and other operational expenses, definitely higher profits. Higher profits, corporate profits, can possibly impact that higher PE ratio. Now, I'm not saying we're necessarily going through that, but it is a factor, and we have to all look carefully at the numbers. So, innovation and growth. There's new products, new services, new companies. All these hyperscalers on the AI space are investing a huge amount of money, expecting to have a very high return on investments. And there is some historical evidence, and let's explore a little more of that and look at some of the projections. Um, Depending who you want to believe on this topic, I've seen productivity numbers up over 40% in a quite short period of time. So, if I summarize, right, the advancements of AI certainly are a factor. It's something we all have to keep a look at. The higher corporate earnings that will result. There's a lot of capex being spent. We need to see those ROIs and those positive valuation models play out. So, is it a bubble that we're building or is building? Well, when we look back, right, you could say, well, the PC era, that had a very positive effect as PCs permeated corporate America. More recently, the dot-com, which is clearly a bubble where we had sky-high valuations driven by everyone talking about a lot of potential, massive investments, but not a lot of profitable business models. So, though there was some productivity gains and a fair amount that happened after the bubble broke, we're in I believe, in the present day, a much different scenario where elevated market valuations due to the potential of AI is certainly out there. And there's significant, very significant investments happening globally, certainly in America. But these are established companies. They are truly boosting productivity, and you hear that from different CFOs, COOs around in all the different sectors. These are real business cases. So I think it's important to consider these kinds of parallels, the potential outcomes, the return on investments that a lot of these AI applications, services, hardware companies, infrastructure build-outs that are going on. So are they sustainable business models is a question we need to keep asking, keep following. And is this genuine innovation or a speculative bubble? Personally, I lean to the first part. I believe it's genuine. Now, another part to this multiple is inflation management, and government policies. Without doing a deep dive into inflation, where are we at historically? What is the trend line? It's clearly been a very positive trend line. The Fed has done a very good job at managing inflation, adjusting policy based on results and prudent data, and steering us down. So, is it a soft landing or a bumpy ride, as I started out with? It's proving to be closer to that softer landing. I think it's yet to be seen what kind of volatility remains, but so far, so good. Now, there's a lot of other data, though, to look at, and I'm cherry picking my favorites on GDP. It got revised up quarter over quarter, so 1.8%. So the domestic growth product is growing in the quarter. That kind of upgrade in real GDP shows that there is continued spending, after-tax income. All the components to it is quite healthy. The labor market's quite healthy. So, when you have a case also where, honestly, I was quite worried when we had the port strike and how many months that was going to last. Luckily, it was a very short strike. But because the way that was telegraphed, there was a big inventory boost. A lot of people got orders in, brought in a lot of goods, and that offset a lot of the net export lags. So that was dodging an economic bullet. However, the consumer has slow but modest forward momentum. It's working out well. I often look at Bank of America and credit and debit card spending. It fell. So healing continues to go on. The personal balance sheet of most Americans is improving, and adjusted spending actually went up just a little bit. So another, the CCI, we talk about PCI now, CCI, the Consumer Confidence Index, slightly increased. So people are feeling better overall. And as I said, unemployment now down at generally a more healthy rate of 4.1%, suggests a good job market, a reasonable job market. And the it goes along the lines of with falling inflation. So some sectors may certainly be affected, and we also have to monitor if we are right in this assumption that there's some structural changes happening with AI. This can also change the labor market positively for companies, but maybe negatively for a lot of workers displaced potentially. So, but overall, the consumer is holding up well. That's the backbone of our economy, and condition trends are quite positive. So we need to, again, see how this reshaping of the job landscape maybe is affected. Now, the other part I like to look at is the money supply and the velocity, transaction velocity. So the M2 is the more liquid measure of just cash and deposits and things easily converted. And our current money supply stands at 21.7 trillion. So there's a lot of money sloshing around in the economy. That's way up from pandemic times. You can see the numbers there. So a huge amount of injection of capital into the market, and that sloshing around is certainly being felt and worked out through the economy as the impact of inflation and interest rates is felt. The Federal Reserve will continue to adjust those rates, I believe, and keep things on the higher for longer, but the slow and steady decline, and maybe spacing out some of the expected rate cuts, I believe are prudent, and certainly the numbers and the data holds up to that. When I look at and think about velocity, right, another important part, how many transactions are happening, how quickly are those transactions happening, and this is also a good overall gauge of economic activity. And if you don't follow it, currently we're at 1.25 for a velocity, the M2 money. It's a decrease from pre-pandemic levels, 1.46. Now that decrease is positive. I think there's room to run. I think with the sloshing of money, the overall healthy numbers, and these different metrics we just covered, that I would expect us to get back up higher. So I actually think the number of transactions should increase and get us back to that 1.4 kind of number. So I think economic activity will continue to increase. The lower velocity suggests slower economic activity, but I see it the other way. There's room to run. So I'm actually was bullish to see that number come up. So we can, I think, expect an increase in velocity. Now, based on all of that, Alpha V looks at portfolios, the equity markets through 4 different risk lenses, up to 4 different ones. We look at the market. So when the market obviously goes down, everything, even good stocks, decline. So we have an indicator where we look at asset allocations between fixed income and equities. We look at inflation and ways to manage impacts from inflation on our portfolios. We look at the sectors, which sectors are likely to accelerate, which ones are likely to decelerate, and then finally pick names. And we're very much on the fundamental side of life, where we look at boring fundamentals, income statements and balance sheets, and apply fundamental factors generally. And as we look beyond that horizon, as I said, Alpha V monitors a trend line in reported fundamentals of over 1,000 major companies. Every 2 weeks, we do a temperature check of the markets. We then deconstruct all those incoming data to value and quality as part of that trend line, and we look at all the different sector behaviors and peer group rankings and scorings, we want to see who's accelerating and decelerating. So today, for our next 90 days, we're positioned, or for this quarter, to be 90% in equities, 10% in treasuries. We prefer the 7 to 10 year intermediary ourselves. Some use SHV, some use other instruments to get that exposure. And we have the outline of the 5 sectors. We like to look at the classical 10 sector definition. We don't like to jump around and change our sector definition. So cyclical goods, and well, you can see them all listed here: industrials, non-cyclicals, tech, and energy are our 5 sectors for this quarter that we're focused on, and quite overweight on tech, by the way. Now, we use a different number of risk lenses, 2, 3, or 4, depending on the focus in our suite of strategies. So we have the top 5 sector family, a enhanced U.S. equity, which is across all sectors, and even a couple of Canadian ones to our friends up north. If you're interested in following these, almost all of our models you can follow on CNBC or on the exchange. They're on a variety of platforms, so definitely look us up and follow along. Now, we distribute a lot of this research on different platforms, and we're always looking to add additional platforms. So if you need us on a platform, if you'd like to direct index with us directly and get that research, please reach out to your AlphaV representative, info@alphav.com. And we'd like to work more with you. So again, think of that top 5 sector family, how it plays out. And the other question is, what allocation is appropriate for risk management for all of your clients today? So with that, I'm going to end here. Thank you, and please reach out with questions and comments.